And you ready for your day. All right, earnings season heating up this week. 129 companies expected to report. Highlights include Morgan Stanley, IBM, Apple, Microsoft, Boeing, Amazon, and McDonald's. Now that's a week for you. Lindsey, what's your take on the numbers so far?
Well, as we currently stand, second quarter earnings for the S&P 500 are expected to decline 3.3%, but we're moving in the right direction. That's being largely weighed on by the energy sector, which is expected to contract 60% this quarter. The good news is, though, at the start of earnings season, the earnings contraction was pegged at 4.5%, but the banks, they're holding us up here. Last week, the money centers, a lot of the large regionals, they reported much better than expected results as they manage expenses. They get boosts from M&A activity and equity markets.
All right, talk to me about bank earnings, because we had a bunch of them last week. I want to remind everybody we're waiting on Morgan Stanley. Estimates right now, earnings per share 74 cents. Revenues expected $9.1 billion for the quarter. What do you like the banks here?
You know, we do like the banks because they are doing that expense management that they're expecting to see increases going forward. So look at JP Morgan. They actually cut out voicemail and they're no longer going to have it. Going to save them $1 billion by removing voicemail. But when we talk about Morgan Stanley, Gorman actually has projections where he wants to get to double-digit return on equity. And one of the reasons he's going to do that is he's starting to get back into the more fixed income trading side of it. So you saw him come out of the recession, focusing on asset management. He's done that well. Now things have stabilized. They've got a good book of business there. Now they're going to start getting into slowly back into the fixed income trading side, which really hurt them in the past.
Morgan, the way I could bring you in on this is because we're talking about bank earnings at a very crucial time politically for the banks, because you've got presidential candidates like Hillary Clinton talking about more bank regulation. I mean, going further than Dodd-Frank. Dodd-Frank has arguably already stripped these banks' ability to make the kinds of money that they have made in the past. It's been a difficult environment. Do you expect more tough talk on Wall Street as we enter into 2016?
Well, I think it's easy to beat up on the banks politically. I mean, Republican or Democrat, who wants to be on the side of the big banks? And I think really what will happen in 2016, who wins the presidency, who has control of the Senate? Because right now, clearly we have a Republican Senate, but it's going to be a really tough battleground for the Republicans for the Senate. So in 2017, if we have a Democratic president and a Democratic Senate, then there could possibly be some move on this legislation. I don't really see it otherwise.
I've always found it amazing that candidates like Hillary Clinton get so much of her money from Wall Street, but yet she's talking about imposing more rules and regs on Wall Street. Lindsey, at the same time, these banks have to deal whatever blows are given them. What do you think more regulation on the sector, what kind of impact would it have?
Well, it definitely hurts, and I think the good thing that we've heard out of the banks so far is that net interest margins have stabilized, and I think people were expecting them to continue to come downward as interest rates remain at very low levels. People are betting on the banks that the interest rate boost potentially in the second half of the year will help them. You're also seeing loan growth that's respectable in the 2 to 3%
loan
range.
Growth is good. I mean, and by the way, when we're talking about the banks, Kevin, we're going to leave it there. But give me a little teaser here. What are you expecting as far as interest rates? I mean, banks, any bank performance that we're talking about is going to be hinged on when we get that first hike.
Yeah, you should expect a first hike going into September. You're not going to want to see the Fed raise it during the holidays.
You think September's going to be?
Yeah, absolutely. Look at the dot plot. Look at what's happening. I mean, look at the Fed's mandates. Where are jobs? Jobs are doing great. We're at 5.5%. They're going to have to do something. The market needs them to do something.
Wow. Even though Fed fund futures right now are still pushing it out to December, you're sticking with September. All right, we're going to chat more about that a little bit later. Thank you, Lindsey Bell.